All right, we're diving deep into the Solana ecosystem today to really pull back the curtain on one of its most powerful and, let's be real, riskiest yield engines. Today, we're demystifying JLP.
When you hear the word Solana, what's the first thing that pops into your head? For most people, it's got to be the meme coins, right? Just absolute madness. And hey, it's a reputation the chain has definitely earned.
But what if I told you that underneath all that hype, all that noise, there's a serious engine quietly generating some of the most eye-popping returns in all of DeFi? Well, that's exactly what we're going to break down.
Okay, so let's start with the absolute basics. What in the world is this JLP token that people keep talking about?
So in the simplest terms, think of JLP like a receipt. You deposit your crypto into this giant pool on Jupiter, which is Solana's #1 DEX, and in return, they hand you these JLP tokens. And that pool, it's the lifeblood of Jupiter's Perpetuals trading platform. It's the money that leveraged traders are borrowing against. Now, what's in that pool is super important. It's not just one thing. It's this whole basket of blue-chip crypto and stablecoins. You've got a huge chunk of SOL, of course, but also a lot of USDC, Bitcoin, and Ethereum. So holding JLP is almost like owning a crypto index fund. That diversification is really key to how it all works.
So how does this whole thing generate yield? Well, this is where JLP gets its unique and kind of controversial edge. This is where it gets its nickname, the house. Okay, this is the most critical piece of the puzzle. When you hold JLP, you aren't just a passive investor. You are on the other side of every single trade that happens on Jupiter's Perpetuals exchange. You are the casino. So here's how that plays out. Let's say a trader makes a big leveraged bet that SOL is going to the moon. And they're right, the price pumps. Where do their winnings come from? They get paid out directly from the JLP pool. The pool's total value literally goes down to pay that winning trader. But here's the other side of that coin. When a trader gets it wrong, when their position gets liquidated, that money gets absorbed by the JLP pool. The whole model, the entire bet here, is built on this historical fact that, over the long run, most people who use leverage, well, they lose money. And the house, in this case the JLP pool, is there to collect. So just to sum it up, there are three main things that make the value of JLP go up. One, pretty simple, the price of the actual crypto in the pool goes up. Two, it scoops up the net losses from traders. And three, it earns a whopping 75% of all the trading fees on the platform, and all of that gets automatically reinvested right back into the pool, making every single JLP token worth a little bit more.
Okay, so you see the mechanism now. Let's dig into why JLP has grabbed so much attention and capital lately.
Yeah, that number. That's a big part of the story, isn't it? An APY floating north of 100%? The crucial thing here is that this isn't yield from some inflationary token being printed out of thin air. This is what people in DeFi call real yield. It's generated from actual platform revenue. And that is a powerful, powerful magnet for money.
And you can see that yield isn't just a fantasy. It's fueled by real, consistent growth. Just look at the trading volume and the total value locked. It's been on a steady climb. More volume means more fees, and more fees mean higher returns for anyone holding JLP. It's a direct connection.
And the Jupiter team isn't just sitting still. They keep adding new layers, new reasons to hold JLP. You can now use it as collateral to borrow stablecoins, all while your JLP is still earning that crazy yield. They're even staking the SOL that's just sitting in the pool to get a little extra juice. Every new feature just makes JLP more efficient and more attractive.
Okay, 100% APY, exploding volume, more and more utility. This sounds a little too good to be true, doesn't it? So, what's the catch? Let's talk about the risks, because there are absolutely risks here.
And there are several big ones. First, what if the house doesn't always win? What if a bunch of really smart traders show up and just have an incredible winning streak? They could, in theory, drain the pool. Second, you've got straight-up market risk. The pool is full of volatile crypto. A nasty bear market would slam the value of JLP. Then you have fierce competition. And of course, the ever-present boogeyman of DeFi, smart contract hacks.
And you don't have to look far to find people pointing out these red flags. Check this out from @AI4Alpha, who brings up a huge one, token concentration. 80% of all JLP is held by just 10 wallets. That is a massive risk. What happens if one or two of those whales decide to sell? It could get ugly fast.
And that competition we mentioned, it is very real. As @CoolCrypto223 points out here, Jupiter's model isn't the only game in town.
There are newer exchanges popping up with different models, like CLOBs, that some traders prefer. If Jupiter can't compete on fees and liquidity, that revenue that feeds JLP could start to dry up.
And we just can't ignore security. The recent massive hack of Drift protocol is a perfect example. Millions of JLP tokens were stolen. Now, to be perfectly clear, it wasn't a flaw in Jupiter's own code, but it's a brutal reminder that everything in DeFi is connected, and a vulnerability anywhere can cause problems everywhere. It's systemic risk.
So, after all that, weighing the incredible potential against some pretty serious risks, what's the bottom line? What's the final verdict on JLP?
Look, if you remember one thing from all of this, let it be this. JLP is more than just a passive crypto index. It is an active, leveraged bet on the entire health and vibrancy of the Solana DeFi ecosystem. Its success is directly tied to trading volume, the price of SOL, and that all-important assumption that traders, on the whole, will keep losing more than they win. And all of that leaves us with the big, final question. Is this innovative model the actual future of sustainable yield in crypto? Or is it a really high-stakes gamble that's just propped up by a bull market and is bound to face a painful reckoning someday? Well, that's for you to decide.